So, you've diligently saved up some money. That's fantastic. It's a crucial first step towards building a secure financial future. You've worked hard, made sacrifices, and now you have a pool of capital ready to be put to work. This is where the exciting part begins, the part where your money starts to make money. Now comes the big question: where should you invest it? The possibilities can seem endless, and the choices can be overwhelming. Do you play it safe, or do you take a chance on something with higher potential returns? It's a decision that requires careful consideration and a clear understanding of your own risk tolerance and financial goals. On one side, we have a relatively new player in the investment game, the wild, high-risk world of cryptocurrency, a digital frontier filled with both incredible opportunities and significant dangers. It's a market that operates 24/7, driven by global sentiment and technological innovation. A world filled with stories of overnight millionaires, fueled by the meteoric rise of Bitcoin and other digital currencies. These stories capture the imagination and tempt investors with the promise of rapid wealth accumulation. On the other side, we have a more established and traditional approach, the steady, proven path of index funds, a diversified investment strategy that aims to mirror the performance of a specific market index like the S&P 500, a strategy favored by long-term investors, those who prioritize stability and consistent growth over the allure of quick riches. It's a patient approach, focused on building wealth gradually over time. Investing in crypto is a bit like betting on a tech startup. You're identifying a potentially disruptive technology and hoping it takes off. The potential for huge gains is definitely there. If you pick the right crypto at the right time, your investment could multiply exponentially. But remember, you could also lose it all. The cryptocurrency market is notoriously volatile, and prices can plummet just as quickly as they rise. Index funds, on the other hand, are a slow, steady bet. They're not designed to make you rich overnight. Instead, they offer a reliable way to participate in the entire market's growth, spreading your risk across a wide range of companies and sectors. So, the real question you need to ask yourself is, do you want a risky shot at big gains, knowing that you could lose a significant portion of your investment? Are you comfortable with the emotional roller coaster of the crypto market? Or do you prefer a more reliable way to build wealth over time, even if it means sacrificing the potential for explosive returns? Are you willing to be patient and let your investments grow steadily over the long haul? In this chapter, we'll break down what each option really means, going beyond the headlines and hype. We'll delve into the underlying principles and mechanics of both cryptocurrency and index fund investing. We'll explore the risks associated with each investment, helping you understand the potential downsides and how to mitigate them. And we'll examine the potential rewards, outlining the possible benefits and how to maximize your returns. Ultimately, we'll help you understand how to choose the investment strategy that best fits your individual goals, risk tolerance, and time horizon. We'll provide you with the knowledge and tools you need to make informed decisions about your financial future. By the end of this chapter, you'll have a much clearer understanding of the pros and cons of both cryptocurrency and index fund investing. And you'll know which path makes the most sense for you, empowering you to take control of your financial future with confidence. Let's dive into the world of building wealth gradually over time. Crypto is famous for wild price swings, up 20% one day, down 50% the next. The upside? Massive gains are possible, but so are total losses. Many coins have crashed to zero, wiping out investors. Index funds, in contrast, are much less volatile. The market has bad days, but crashes are rare, and long-term growth is steady. Historically, index funds return about 10% per year, slow but reliable. Crypto is the hair-fast, risky, and unpredictable. Index funds are the tortoise, slow, steady, and proven. Which fits your risk tolerance? Buying crypto is easy 24/7 access on exchanges like Coinbase. But constant trading can tempt you into risky moves. Index funds are bought through brokerages during market hours, which helps curb impulsive decisions. Index funds offer instant diversification, one fund, hundreds of companies. Crypto? Even if you own many coins, the whole market often moves together, so you're not truly diversified. Index funds spread your risk. Crypto concentrates it. Think about how much risk you want in your portfolio. The way you buy and what you own matters. As you navigate the world of investments, it's crucial to understand the tax implications and regulatory landscape surrounding both cryptocurrency and index funds. These two investment vehicles, while offering distinct opportunities, also come with their own set of rules and considerations. Both crypto and index funds are taxed on profits. When you sell an asset for more than you bought it for, that difference is considered a capital gain, and the government wants its share. Understanding how these gains are calculated and reported is essential for responsible investing. But the rules and protections differ significantly between these two asset classes. This difference stems from the regulatory frameworks that govern them. Stocks, particularly those held within index funds, are heavily regulated by bodies like the Securities and Exchange Commission, SEC. These regulations are designed to protect investors and ensure fair market practices. This robust regulatory framework provides investor protections, including requirements for transparency, financial reporting, and safeguards against fraud and manipulation. These protections offer a level of security and confidence to investors in the stock market. Crypto, on the other hand, is a relatively new asset class and is less regulated than traditional investments like stocks. While regulations are evolving, the crypto market currently operates with less oversight. This lack of regulation means that scams and hacks are real risks in the crypto world. The decentralized nature of cryptocurrencies makes it more challenging to recover lost funds or pursue legal recourse in the event of fraud or theft. As a crypto investor, you're largely responsible for your own security. Protecting your digital wallets and private keys is paramount to preventing loss or theft. This requires a proactive approach to cybersecurity and a thorough understanding of the risks involved. So, with all these factors in mind, which investment is right for you? The answer depends on your individual risk tolerance, financial goals, and investment knowledge. If you crave big risks and potential rewards and you're comfortable with the volatility and uncertainty of the crypto market, a small allocation to crypto might make sense. However, be prepared for significant price swings and the potential for substantial losses. Remember, even if you're drawn to the potential of crypto, a small crypto allocation, perhaps no more than 5 to 10% of your portfolio, might be a prudent approach to manage risk. For most investors, particularly those seeking long-term growth and stability, index funds are the safer, more stress-free way to build wealth. Their diversification and lower volatility make them a suitable choice for those with a lower risk tolerance. It's also worth noting that many investors use both crypto and index funds in their portfolios, creating a diversified approach to wealth building. In such cases, the majority of the portfolio is typically allocated to index funds, providing a stable foundation for long-term growth. Then, a small slice is allocated to crypto for speculation, allowing investors to participate in the potential upside of this emerging asset class without exposing their entire portfolio to excessive risk. Ultimately, whatever you choose to invest in, whether it's crypto, index funds, or a combination of both, it's essential to do your research and understand the risks involved. Don't rely solely on the advice of others. Take the time to educate yourself and make informed decisions. And above all, never invest more than you can afford to lose. Investing should be a calculated risk, not a gamble that could jeopardize your financial well-being. The best investment in the end is the one that lets you sleep soundly at night, knowing that you've made a responsible and informed decision that aligns with your financial goals and risk tolerance. Investing should empower you, not keep you up worrying.